Hi, everyone. I'm Bill Gebhardt, founder and executive director here at 10 Dynamics. You're listening to the audio edition of our first ever white paper. In it, we're exploring risk management and systematic trading. We'll give exclusive insights into our innovative risk management system called the Freezer. We'll cover how and why we built this system, what it does, and how our proactive risk systems produce a genuine competitive advantage for our strategy. I'd love to hear your feedback, questions, or comments, so please leave them below or reach out to us directly. I hope you enjoy the episode. As systematic trading systems become increasingly sophisticated, so must the mechanisms designed to manage and mitigate their associated risks. This podcast outlines some of the risk management challenges faced by algorithmic trading models and the technical frameworks employed by 10 Dynamics to manage, mitigate, and track both portfolio and operational risk. Systematic trading, by its nature, relies on automated processes to execute trades based on predefined rules. While this approach offers significant advantages like speed, efficiency, and the elimination of human error, it also presents its own set of unique challenges. Without proper operational and portfolio risk management, even the most well-designed trading algorithms can inadvertently make incorrect trades. This can lead to overtrading and excess execution costs at best, and trading errors or incorrect positions at worst. Our approach to risk mitigation is proactive and multifaceted, encompassing a range of strategies and technologies to address the various dimensions of risk. This podcast explores and explains a critical component of the specific architecture we have developed and deployed, which we call the Freezer, highlighting its effectiveness in minimizing risk and ensuring the stability and accurate execution of our trading operations. Typically, firms will go into great detail to explain the workings of the alpha-generating portion of their systematic trading operations, while treating risk management as a box to be ticked. Instead, we believe that the Freezer is a competitive element of our work, and we'll use this podcast to explain how and why. In the early days of developing and testing our system, the importance of carefully designed error handling became readily apparent. Bad data would cause the system to throw errors, halting all potential trading activities. Once running live, this could have been highly disruptive due to the opportunity cost associated with stopping trades that were based on otherwise good data. We realized that market risk, operations, and data quality management rules are highly intertwined, and that we needed to codify explicit protocols into our system, addressing not only what errors to catch, but equally importantly, what actions to take when they appear. Our work on the Freezer is a response to existing risk management challenges in both systematic and discretionary trading. In fact, much of our team's expertise and knowledge in risk management is derived from their collective experience of managing similar risk in teams where people perform the trading. There are three key categories of risk management challenges which are shared between human-based and systematic trading strategies. The first concerns faulty, incomplete, or anomalous data leading to false signals. The second is portfolio volatility management. And finally, third, are delays in issue resolution, leading to a lack of profitability. While the third category may not traditionally be labeled as risk management, long pauses of the returns generating part of the business will quickly lead to underperformance against a benchmark. For a systematic risk management system like the Freezer, the question becomes how much of the system to halt or freeze, for how long, then how and when the system's functions should be reactivated. This trade-off between profitability and risk management is the most important challenge which the Freezer is designed to resolve. The 10 Dynamics team have many years of experience in existing risk management strategies and requirements. The challenge of building the Freezer was to proceduralize, optimize, and deploy that knowledge into an autonomous day-to-day solution. Our approach to both alpha generation and risk management is underpinned by a knowledge-based or expert-based approach. Autonomous systems generally take two types of approaches to decision-making. These two types of approaches are, firstly, expert systems that are an autonomous implementation of existing human best practice, typically derived from a combination of experience, research, and professional expertise. And secondly, search-based systems which seek to generate their own rules and heuristics from a sample data set, with deep learning being a classic example. Now let's take a look at Figure 1, which illustrates the knowledge versus search data modeling spectrum with some examples. This diagram shows a spectrum of data modeling approaches, ranging from purely knowledge-based systems such as 10 Dynamics models on one end, and heavily search-based systems like AlphaGo on the other. Various other examples are plotted along this spectrum, helping to visualize where different approaches fall. TAD, our core model generally, and the freezer specifically, uses a knowledge-based philosophy throughout, meaning that the developers implement a growing set of known error types based on years of trading experience. This is instead of attempting to generate or discover new rules using some form of data mining. Operational risk management is a mature and well-explored space. An experienced team like 10 Dynamics has good awareness of both the types of possible errors and of their consequences. Given the difficulty of creating a data set with all potential operational and data errors before they occur, in order to train a machine learning model, risk is an area which requires proactive implementation of human experience. It's especially unlikely that a novel and reactive search-based method would reliably discover a new type of unknown error, and even less likely that it would be able to devise a suitable remedy. Therefore, risk is an area which requires proactive implementation of human experience. From an operational perspective, it's critical that these systems are transparent and comprehensible. Sophisticated investors require visibility of the risk management systems employed by the firm in which they are investing. A reactive approach would yield a more fragile and complex set of error types, which would be far harder to categorize, delineate, and explain during a due diligence process. When considering the philosophy of the freezer, we started with some simple heuristics and followed them through to their logical implications. These rules were reduced down to the following three beliefs. 1. Data errors happen and cannot be eliminated. 2. The risks from automatically trading on incorrect data are best categorized as low probability but high severity and can be extremely nonlinear and out of proportion. And lastly, the cost of freezing the system is roughly proportional to how much of the system's trading capacity is shut down and for how long. Any risk or process control system faces the unavoidable trade-off between type 1 errors, false positives, and type 2 errors, false negatives. Reducing the chances of one increases the chances of the other. Combining the probability of each type of error with its potential cost allows us to represent the decision to shut down a given process and can be simplified to a mathematical equation balancing these factors. Simply put, we take the average drawdown cost, D, multiplied by likelihood of that drawdown, beta, and we compare it with the cost of shutting down the system times the amount of the system shut down, S, and the time it's shut down for, T. Roughly speaking, this relationship shows that the optimal trade-off occurs when the expected loss of false positives equals the expected loss of a false negative. While it's difficult to make this relationship precise, since alpha and beta are often unknown or only roughly estimated, we can see that for many errors, the potential loss from an error is much greater than the cost of being offline. Since the cost of being offline, the alpha not generated against a benchmark, is fixed, our goal with the freezer is to minimize both the scope and duration of any freeze. That is, we aim to keep as little of the system offline and for as short a time as possible. In addition to standard freezing, which is a negative process triggered by a negative signal from the system, we have a positive shutdown process modeled on methods used to monitor nuclear reactors, hospital patients, and similarly critical systems. In a positive signal or heartbeat approach, the core systems produce a set of constant positive signals, indicating that the system is online, healthy, and acting as normal. If, for any reason, that positive signal is absent or undetected by the monitoring process, in our system's lexicon, an arrhythmia occurs, and that is considered an error. Now let's talk specifically about the freezer. The freezer is a novel, proprietary, and autonomous risk management apparatus running alongside the wider 10 Dynamics system, which systematically freezes and thaws sections of the trading platform and flags this activity to a human monitor. The alpha-generating portion of the system is called TAD and operates across markets using ticker, benchmark, and portfolio information to trade liquid assets, including listed equities and commodity futures contracts. TAD consumes security data such as prices, does analysis on it, and executes trades autonomously without humans inside of that loop. There's a series of live feeds into a data repository. However, most information is instantiated, validated, and acted upon in discrete cycles, rather than continually streaming. The two elements we will explore in this podcast are the freezer and the validator. The validator's job is checking if new information fits knowledge-based expectations about a specific object. For example, an asset price or a portfolio statistic, If that object is found to be invalid, it's passed to the freezer, which then uses its own lists of knowledge-based rules to act within TAD, freezing portions of the system and its processes. Let me describe Figure 2, which illustrates the system's data ingestion and validation process. This diagram shows how data flows through the system, starting with incoming data, passing through the validator and invalid objects being sent to the freezer if issues are detected. Specifically, the freezer's job is to halt specific portions of TAD's trading activity. As will be obvious to the listener, this is a fine-tuned activity. Halt too much or for too long and you drift away from your targeted returns. But don't freeze enough and you may increase costs or even suffer operationally related drawdowns which harm overall performance. Using an object-oriented language like Python means that each piece of information fed into the system, for example, an equity ticker symbol, is transformed and represented as an object. That is, a list of standardized fields and the values for those fields. This means that alongside standard incoming financial information on an asset such as a price point, stock split, or interest rate, we're able to generate and append our own metadata, which the object, in this case, an asset price, carries around with it inside of our system. One piece of metadata we append is our validity Boolean variable, which is attached to every data point passed into and around the system. Figure 3 illustrates how object-oriented data points are both relational and hierarchical in the system's logic. This diagram helps visualize how different data objects relate to each other and how they fit into a predefined structure within the system. As mentioned above, 10 Dynamics uses a knowledge-based approach to identifying and encoding errors. This means that the list of errors and how much of the system they freeze is predefined using a combination of research, testing, and continuous improvement. As of today, there are 19 categories of errors in the system, ranging from collections of objects such as fund errors to specific object functions such as equity errors. Inside of these categories, there is a refined list of hundreds of errors which correspond to specific sets of objects to be frozen, lock times for those objects, and other restrictions including global halts. Figure 4 provides examples of errors, their relative criticalities and complexities. This diagram helps illustrate the range of error types the system deals with and how they vary in terms of severity and complexity. Another class of errors relates to wildcarding. This means freezing any object of a particular type. In normal operation, the freezer freezes a single object which then affects all the associated objects to one degree of freedom. Under wildcarding, the system freezes all examples of a specific object type. This is because some errors indicate an extensive systemic problem with data, in the markets or across portfolios more generally. For example, if the Brent crude futures price becomes negative, which happened briefly in 2020, the error created in the system by a negative price should wildcard all Brent futures objects held in all portfolios throughout the system. In this situation, that error strongly indicated a universal and reliably anomalous situation. This is subtly but critically different to a general shutdown or a freeze of all portfolios because it gives the human monitor important information about what type of object has caused the freeze and at what level. Each of these error categories has 7 associated variables, where the goal is to carefully balance the need to freeze elements of the system with a desire to keep other profitable functions online. When an error occurs, the freezer consults the specific error type to understand which objects and activities should be frozen, for how long and under what circumstances they should be unfrozen or thawed. These variables include the error code, freeze level, stop trading flag, short restrictions flag, auto unlock flag, lock minutes, and send notification flag. The validator serves as a crucial component within the freezer system, acting as a delegator. When data is passed into the validator, it identifies the error and utilizes the corresponding error attributes. This determines the appropriate management strategy within the freezer. For instance, consider a scenario where we need to verify whether the number of trades executed in the last 24 hours exceeds the expected frequency for a given account. This calculation is performed regularly across all accounts. If an account's trade volume surpasses the expected threshold, the system filters out that account and passes it to the validator along with the specific error code. For example, error code 1. The validator then queries the metadata associated with this error code and places the account into the freezer. Consequently, the account receives an invalid state and is prohibited from executing any trades until the specified period elapses, or the error is manually overridden. In Figure 5, we can see how data is first checked, then filtered before it's passed to the validator. From there, the error attributes are checked, and where relevant, the data is passed on to the freezer. Let's look at some example flows. Every 30 minutes, the Apple ticker object is instantiated and validated. This checks for price data consistency and quality. One of the checks ensures that the previous known price is within 4 standard deviations of the new price. If the new price deviates by more than 4 standard deviations, the object is marked as invalid. If the Apple ticker underwent a stock split the previous day and our corporate action systems failed to recognize the split, the new price would significantly differ from the last known pre-split price. The validator would detect this discrepancy and set the validation state to invalid. Consequently, the Apple stock would be placed in the freezer and would not be traded until the issue is resolved. Figure 6 shows how this information is passed first to the validator, which then checks for this particular error before its validity is updated. Let's look at another example. On each batch run, TAD requests the live positions from a given portfolio management system. And if, for whatever reason, no positions are returned, the fund object would be interrogated by the validator and then placed into the freezer. No new trades would be allowed to be executed until positions were available for the fund. We can see in Figure 7 how this flow works. Now let's briefly talk about reporting and the graphical interface, TDX. TDX is a graphical user interface developed internally to streamline the management of various operational aspects of our systematic trading system. TDX provides comprehensive control over objects in the freezer, enabling users to override, thaw, and freeze objects as needed. In addition, positive heartbeats and any arrhythmias are also constantly reported to the user inside of the graphical interface and via email and instant messaging platforms. There's a graphical representation of the health of the positive heartbeat signals and a series of proactive alerts and notifications which are sent out if the heartbeats are lost. Now let's look in detail at how we minimize the amount of time the system is offline for. In order to protect profitability, trading must be frozen for the minimum amount of time possible and brought back online, either automatically or manually, as quickly as is safely possible. All errors are made available to the user monitoring the system, who is then able to perform manual overrides based on their expertise. This human override is critical because although there is a discrete list of possible errors, in the real world there is an almost infinite number of causes for those errors. The amount of time that a freeze occurs for can be minimized through 2 main actions: overriding and automatic thawing. The freezer system includes the capability to override errors. Continuing with a previous example, suppose an unanticipated yet valid high trade count was detected and flagged, leading the validator to move the account to the freezer. In such cases, overriding the freeze for the account is possible. There are 2 modes for overriding a freeze: a temporary override and an indefinite override. A temporary override exists until the relevant market closes, after which normal validation procedures resume. On the other hand, an indefinite override remains in effect indefinitely until manually revoked. Overriding is essential to minimizing the amount of time a given process or object is frozen for, and for responding to unusual or unexpected market conditions. Although there are a discrete number of errors, these errors can arise for a variety of reasons which may be acceptable to the human monitor. That human has the ability to manually accept those errors and use their expertise to respond by either overriding or modifying the underlying error rule logic. Some error types have automatic thawing inbuilt, using the lock minutes variable. This means that after a set period of time that freeze is removed and trading can continue. This helps minimize T, the time the object or function is frozen for, and is possible because some issues will be caused by insignificant short-term errors with the data. For items in the freezer that are not set to auto-unlock, human intervention is required to release or thaw the object from the freezer. This ensures that any underlying issues are resolved and verified by a human before the object is permitted to trade again, adding an additional layer of scrutiny and safety to the process. Error propagation management is handled by a small number of second-order error types, which pick up first-order errors and propagate them further into the system. This approach ensures that where second-order objects are negatively affected by an underlying error, that object is frozen but without allowing smaller errors to ripple through the system or cause a chain reaction. For example, if a spread uses a subticker that becomes frozen, then the overall ticker of the spread will also be frozen. Throughout the development of the freezer, we have faced a set of complex technical hurdles. These challenges have each been resolved, and the freezer now has multiple years of successful business-as-usual operation. Principally, to create a sophisticated, automated, and scalable system such as the freezer requires the building of a comprehensive and accurate taxonomy of object types and their relationships. It also requires a clear and demonstrable causal chain for every relationship, calculation, and result used by the system. And it requires the design of a set of generic tests for all objects while carefully considering how objects could act unexpectedly, either inside our system or in the marketplace. Finally, it's critical to maintain a development environment that properly mirrors the real world in order to identify errors pre-deployment and to commit the resources, budgets, and time to allow thorough testing of all updates before they are implemented. Regardless of the sophistication of the system, its design and implementation, based on our experience and expert knowledge, we know that the most important future challenge by far is another black swan event, something exogenous, truly unexpected and unforeseen, which cannot be automatically mitigated. When this happens and it falls outside the freezer's historical experience, we fall back on our core principle. When in doubt, don't trade, and manually freeze any or all aspects of the system with a few clicks of the mouse. In our many years of operation, we've never needed to manually freeze large sections of the system, and while we hope that this continues, the freezer is prepared in case it does not. There are three key benefits of the freezer. Firstly, the freezer works mostly autonomously, allowing 10 Dynamics team members to work on innovation, monitoring, and continuous development. Secondly, the freezer can also be used to monitor and enforce market risk limits using the exact same process as operational risk management. Finally, because the freezer is knowledge-based and comprehensible, the team can quickly and clearly represent its value during operational due diligence processes. Because the freezer is both conservative and a robust fail-safe, it is largely autonomous, which leaves the 10 Dynamics team free to work on improvement and innovation. We've entered a virtuous circle where our small and highly experienced team spends the vast majority of their time working on further improvements, while the system provides 24/7 monitoring. This is only possible because of the freezer. Secondly, through the freezer, we are able to consistently optimize and control our risk budgets for returns-generating activity. In conjunction with TAD, we can target specific levels of volatility and enforce limits in real time, which is only possible because of the generality of the freezer's process. Lastly, we are able to quickly and professionally respond to both operational and investment due diligence questions from increasingly sophisticated institutional investors. This means that investors can spend more time considering the opportunities and less time on the important but tedious paperwork. Critically, because we use an advanced knowledge-based approach, the freezer's simple, clear, and robust risk management frameworks demonstrate our commitment to exceeding investor expectations of risk management. To sum up, the freezer is a proactive, systematic, and automated knowledge-based system running alongside 10 Dynamics trading technology, which conservatively freezes data and other objects either in part or in total in order to manage risk and keep trading operational as much as possible. The key goal of the system is to freeze as little as possible, for as short a time as possible, without risking drawdowns due to erroneous, missing, or out-of-tolerance data. The ultimate benefactor of the freezer is the investor, because risk is professionally and continuously managed, limiting data and operational-related drawdowns. Human capital at the firm is used for continuous innovation and monitoring, and risk management is knowledge-based and therefore transparent, clear, and explicable. Thanks for listening, and I hope you found this white paper useful. The print version, including all of the charts and figures we've discussed today, can be found on our website. If you like what we're doing or you want more info and you're a professional investor, then please reach out to us directly at inquiries@10dynamics.com. Until then, please share this episode with a friend or colleague, and we'll see you next time.